All right, we've all heard the headlines about the so-called trade negotiation and trade wars with this country and that country. But one thing we aren't hearing a lot about is why the United States should probably consider playing nice with Japan and China. Let's start at the beginning. First of all, in case you didn't know, you're not the only one that needs a loan every now and then. When the United States government needs money to pay for things like roads, schools, military equipment, or social programs, it borrows money by selling what are called Treasury securities, T-bills, T-notes, T-bonds. You may have heard of them. Well, these are just different types of securities, aka loans, the United States government seeks out whenever tax revenues fall short. And yes, you just made the right connection. When tax revenues fall short, instead of raising taxes on the super rich, the United States government borrows money and brands it as issuing securities. Now, what may surprise you is that the people lending money to the United States are not just wealthy individuals or banks or American-based businesses. It's also foreign countries lending money to the U.S. As of the first quarter of 2025, China held over $700 billion worth of United States Treasury securities, which again simply means China has allowed the United States to borrow over $700 billion, which sounds like a lot, but nothing in comparison to Japan. Japan is holding a whopping $1.1 trillion worth of United States Treasury securities. Let's make this tangible. The money the United States owes Japan is almost equal to the entirety of all student loan debt in the United States. That's a significant chunk of America's national debt sitting in the hands of just two countries. But now here's where things get spicy. If Japan or China lost confidence in the United States, maybe because of a political feud, tariff war, or economic instability, and they suddenly dumped all those treasuries, it would be like your bank saying, we don't trust you to pay your mortgage, so we're calling in the full loan right now. And if this were to happen, the U.S. dollar would fall. When Japan or China sell U.S. Treasury securities, they get paid in U.S. dollars. If they then were to exchange those dollars for their own currencies, the global market would suddenly be flooded with U.S. dollars, which would make the value of the dollar decline. Think of it this way. If you have a rare diamond that everyone wants, and suddenly the market is flooded with trillions of the same diamond, the value of that diamond will drop because you can get it anywhere. Well, the same theory applies to money. Further, a weaker dollar means things the U.S. buys from other countries like electronics, clothing, cars, and even groceries such as coffee or produce will become more expensive. Your weekly grocery bill could go up without you changing a single item in your cart. And a weaker dollar wouldn't just make imported goods more expensive, even domestically produced products could cost more. Why? Because a weaker dollar reduces your purchasing power. Your purchasing power is simply the amount of stuff you can buy with $1. So when the dollar loses value, you'll need more dollars to buy the same loaf of bread, to pay for the same amount of gas, or even to buy the same socks, even if they're made right here at home. And if the dollar loses its value, this would make importing goods from countries like China and Japan significantly more expensive for American-based businesses. This would impact the global economy as a whole, since the United States is the largest global consumer. Thus, if the USA stops importing, which really just means buying from abroad, that is going to cause a global crisis. And to make things even worse, interest rates would go up. Why? Well, when people in countries loan money to the United States, they expect to make a little money. That's called interest. The interest on a U.S. Treasury security is the price the United States pays for borrowing money. If there are a whole lot of people or countries lined up waiting to loan money to the United States, the U.S. is going to offer lower interest rates because the demand for U.S. Treasury securities is high. But if China and Japan, two of the United States' largest foreign creditors, were to sell all of their securities all at once, the market would be flooded with U.S. Treasury loans. So in order to attract new investors to buy up all these loans now available on the market, the United States would have to offer investors a greater rate of return, which means interest rates would have to go up. And higher government interest rates usually means higher borrowing costs for everything: mortgages, car loans, student loans, and even credit cards. This is why relationships matter. Japan and China hold so much U.S. debt. Maintaining stable and respectful relationships isn't just about politics, it's about economics. Because if China and Japan were to say, you know what, enough is enough, we are going to have to separate from our mutually benefiting relationship from the USA, your cost of living could rise, your borrowing costs could rise, and the US dollar could lose value internationally. Global finance isn't just about numbers on a spreadsheet. It's about relationships, trust, and mutual growth. Countries like Japan and China don't just hold U.S. Treasury securities because they're feeling generous. They hold them because for now, they believe in the strength and reliability of the United States economy. That trust is a two-way street. A world where major economies work together, not against each other, is a world where innovation, opportunity, and prosperity spread beyond borders. When the U.S. nurtures its global financial relationships, it isn't just protecting its own economy, it's helping build a more stable and collaborative future for everyone. If you are tired of being Frenched up the bass by crooked politicians and thieving CEOs, just hit that subscribe button, because here at Crystal Clear, we keep it simple and sharp, no jargon, just real talk.